I don't know why my thing didn't play, but that's okay. We'll get right into it. It just wanted to give us a little bit of a curveball today, but welcome everybody to Market Mavericks. Who needs this intro? Who needs the intro anyways? The three amigos are back at it. We skipped last week. I wonder whose fault that was, but
It was a consensus.
I just got to do it. Yeah. How was consensus?
Right.
Speaking of which,
A hell of a lot better than consensus last year when everybody was depressed and the SEC was attacking Coinbase and Binance. And there were only 3,000 people. This year, there were 15,000 people.
Ooh.
And the booths were not just accountants and bankruptcy lawyers like last year. So it was a huge improvement, I would say. Vibes are good. Obviously, we had sort of a change in the political winds over the past few weeks. So I think that sort of boosted the mood. Just generally positive. People excited about crypto in the United States. Again, it was great to see.
That's awesome. That sounds great. And I have a feeling that most of the crypto conferences, as long as Bitcoin stays up here, they'll be hopping around this year as well. So I guess let's start with cryptocurrency there, Scott. So we see Bitcoin that's kind of been grinding up. It hasn't taken out the recent highs. I know you kind of were in that sideways consolidation phase the last time we talked 2 weeks ago. Has anything changed in terms of your views about Bitcoin, Ethereum, the ETF approval, anything like that?
Well, obviously, we've chatted since the surprise Ethereum ETF approval on the 19B40s, and we saw that 30-40% move on Ethereum. I guess remains to be seen what will come next from that. As for Bitcoin, exactly right. It's ranging sideways. I've expected it would range sideways for months. I guess we're about 2.5 months into that assumption. I think it could be 4, 5, 6. Wouldn't surprise me at all, especially in context of what we see after each halving. But it's nice to be trading in the top of a range instead of the bottom of a range. Right, because that means that we'll probably at least go test the highs around 73,700. That's the point where people will become irrationally bullish. They'll get exuberant. They'll start talking about 500,000. And then if we go back to 60 after that, they'll be depressed. They'll be talking about 12,000. It's all over, going to zero, because that's what makes charts, and that's what makes supply and demand and support and resistance. But right now, I mean, I'm happy it's at 71,000. Doesn't mean anything to me until we're trading comfortably over, those 74 highs of the all-time high.
So just looking at your chart here, I'm seeing these orange kind of wave areas. Can you explain to people what that is?
This is an indicator that I use that my buddy Wick, you guys, Zero Hedge on Twitter, may have seen that he just finally got me convinced on, at least for a really good screening tool. And it just generally indicates there's volatility coming. It's called it's squeeze shading. So just happens to be an indicator. I usually used to use clean charts here. This has just sort of become my default chart. But at the end of the day, we're just ranging in my mind, right?
Very cool.
in this big blue range. Nice that we bounced from that bottom, got some signals, but yeah, I think now we bounce between 67 and 74. But what do I know? It's just a chart. It's a picture.
In terms of the alts, we've seen, and this has kind of been interesting to me, is that I've seen certain alts make moves. Like Pepe's been pretty hot. Obviously, the meme craze, GameStop, what's going on there is probably influencing it. But even other ones like Chainlink's had a move up recently, and a few other ones. Why are we seeing like some alts run, but then others not? Is it just more story related to each individual one now?
Yeah, I think you get these sort of buckets of narrative. AI coins run, even though most of them have nothing to do with AI, or real world assets coins run, or obviously the meme coin casino going wild. You may not have seen, but there was a story that there were 500,000 tokens launched on Solana in 1 month last month in May. 500,000. Right. So that's obviously something that's a good signal of exuberance and insanity, which was actually my signal that we were topping in March that we discussed, quite a few times. That's only accelerated. But really, I think that most altcoins are still down from last cycle, 90%. Right. We haven't seen this massive altcoin move to the upside across the board. I don't know if we will. If the 4-year cycle is correct, that's more of a 2025 thing or end of 2024. But really, I think that we've had these sort of baskets of interest, but the bulk of the Bitcoin move has come from the spot ETFs, and that money doesn't trickle down into altcoins in the same way it used to. Now, an Ethereum move to the upside with a lot of volume and excitement, that could definitely trickle down further into the ERC20 and a lot of those older tokens.
You mentioned Solana seeing that huge spike in coins being launched. Does that artificially create demand for Solana? Like let's say half of those 500,000 fail. Does that pose any risk to Solana or not really?
I don't know that it poses a risk, but it definitely creates some artificial or casino-like demand, I would say, right? There was a lot of people that showed some pretty compelling evidence months ago that it was actually massive Solana whales that sort of started the meme coin trend, especially when Solana was largely undervalued, had been beaten down by FTX, because it was a way to capture a ton of TVL and volume and excitement in the Solana ecosystem. Because, as you sort of mentioned, if you want to trade these meme coins, you have to own Solana. Right. Trading them in Solana as the base currency largely means you have to buy Solana, trade in and out, come back to Solana. Obviously, that raises the prices.
Interesting. All right. So we see, and this is the chart of Ethereum right now, and it's basically just flagging, right? It's kind of doing what Bitcoin was doing after the run up to 74,000. It's consolidating, if you will. Good support level right here to watch, with upside at least to that 4,100, I would think, and maybe even a little bit higher with this upsloping trend line that I have that goes back quite a ways here, in fact. So, Mike, turning to you in respect to what's going on economically, we've had data that's been generally weaker than expected. Yields have obviously fallen. Just in the last week, we've seen yields coming down pretty sharply. I have a breakdown on yields, in fact, and likely downside target to 4%. What can you tell us about the economy and what is going on right now?
So I got some cool charts to show you on that one, and that's the first one is this thing. I've been talking about TLT for a while, but if you take GLD divided by TLT, total return, see that little white line there? That's a reversion waiting to happen, and it's going to happen suddenly after gradually. I mean, it just looks to me it's more elevated than at the peak in 2011. And one thing that's really different is when people tell me U.S. long bond yields are going to go up, and I've heard that for 3 decades, actually more than that. Every time, and I look over at the rest of the world, is what I show you in orange here is the yield on the U.S. 10-year right now at 4.3% is about 100 basis points above the average of the top 5 other economies in the country. The significance, the last time we hit around 2011, the difference was the yield was about 160 basis points less. So to me, the inflection point that's going to happen on a global basis, at some point, U.S. yields are going to plunge, catch up to the rest of the world, but it's going to take something significant. And the number one key risk for that is the U.S. stock markets. I just want to show a few other charts so we can tilt over from that, because to me, this is going to start. It might have already started. And it just needs an inflection point. So if you look at, one thing I enjoy is you look at Bitcoin, Beta, S&P 500, and gold. If they end the month now, it's another record high close. They're all just hovering there. But one thing I like to point out is a very simplistic way. And Scott knows I've been kind of beating on this one a little bit. If you just look at that Bitcoin to gold ratio, I'm still worried about it. And there's one simple reason to be worried about is when the stock market gets too high. All I show you is the S&P 500 divided by its 100-week moving average, as simple as it goes. You go back to 1999, and this was the longest period in history. And that's the only time we've ever been able to get that Bitcoin gold ratio elevated. But anytime it gets to these levels, you're supposed to be selling Bitcoin and buying gold. It's just the way things work. That's what I want to see change. I want to see Bitcoin go up when the stock market goes down, but so far it's very elevated, and Bitcoin's showing a little bit of divergent weakness. But I want to show you about the cool thing about this simplistic chart. Again, this is just taking how far the S&P 500 is, 20% above a 100-week moving average. I can do that versus everything. I look at that same measure versus gold versus silver. Typically, when it gets this expensive, you want to be buying gold and selling silver. Same thing, when it gets this expensive, you want to be buying gold and selling crude oil. And that's what's happening is crude oil's Bitcoin, gold is breaking out versus crude oil, stuff like that. So the macro to me is quite significantly tilting towards a little bit of recession at some point. I'll end with this one little chart. Let's go back 30 years. And what I show you here is just in orange. That's just the S&P 500 divided by GDP. It's the highest in our lifetimes, with the exception of that little spurt we had for the COVID. And CPI is at the same level as when we went to the peak of the internet connection. The internet boom. Some of us remember trading that well. CPI is the same, 3.4%. The difference is it was heading higher then. And the reason part of it was heading higher was because the stock market was going up so much, but stock market peaked. S&P 500 peaked at right then about 1.5 times GDP. I'm using GDP in trillions times 100. Now it's almost 2 times GDP. It's just that expensive. So to me, to expect inflation to go down, you need the stock market to go down, and I think the Fed gets that.
Interesting. So you actually are in the camp that the Fed is trying to make it so that the stock market goes down? Because I just have a hard time believing that, just because every
No,
time Jerome Powell comes out and
no.
we have a Fed decision, he's always slightly dovish, but then the presidents walk it back afterwards. But really, the stock market just keeps going up. Now, granted, it seems like it's Nvidia mostly doing the work at this point, but still.
So I'm not in that camp, and there's always reasons. And I've only been through by 3 or 4 of these cycles. There's always good reasons to get too expensive and too cheap. What's the latest narrative I care less about? The point is, I think what Chairman Powell did is he made a big mistake when he pivoted towards warning the market is going to be easing back in December. And that's created this speculative frenzy in all assets, which is kept inflation elevated. And it's just silly to expect, with the GD total market capitalization of US stocks at 2 times GDP, which is the most in our lifetimes, not to be the most thing that matters with everything. Then that's all that matters. I mean, seriously, when stock market goes up, everybody feels good. Inflation goes up, market's great. Stock market goes down, it's all the opposite. It's all that matters. Like I said, it's the most expensive in our lifetimes. You got to go back to the 1930s. Now, I've been saying this for a while, but here's the key fact: is inflation's going now. Inflation was heading lower. The reason it's sticky partly is because we've had this big breakout in the stock market. Now we all know why. The tilt from Powell. There's massive money still in the system from all the money pumping from COVID, and then the inordinate fiscal spending that has never happened to this extent, with 6% of GDP outside of a war or recession.
Yeah, it is amazing. I mean, it took me a second to realize that as of yesterday, when Nvidia crossed the $3 trillion market cap threshold, we now had 3 companies that equal about $9.5 trillion. And then I was like, wow, that's, if you look at the US debt, which we all say is a huge issue at 34 to 35 trillion, we're basically talking about 1/4. Those 3 companies just alone in their market cap equal 1/4 of the US debt as a whole. And like you said, I mean, the market cap that is tied up in the $6 trillion companies is the most concentrated that we've seen in decades, if not longer.
So let's talk about that debt premium. So if the U.S. debt's a problem, there should be a premium in yields. I show it recently. That peak here was 120 basis points. The top 5 countries in the world yield 120 basis points less than the U.S. 10-year note. Now it's only about 90 to 100. That's the most in our database. My point is, all that needs is a little inflection point, and the world says, uh-oh, you go straight to U.S. long bond. That's why I'm on my TLT rent. I know it hasn't worked yet, but I'm pointing out how extreme this is. It looks like in GLD, I still expect gold to rally. I'm bullish gold, but this peak is very similar to what happened in 2011. Look at the difference. Back here,
yeah, I was just,
I think TLT is up about $10. I think TLT is up about $10 since we started that rant. It was in the low 80s. So I wouldn't say it hasn't worked. I would just say it hasn't gone parabolic.
That's a good point. For me, this is how bad it got. I didn't think, we did this little blip and we got this bad, TLT versus gold. A normal reversion is all the way back down here. And these kind of things happen really fast. Reversion is the most powerful force in markets.
Yeah, and I was just going to pop up my TLT chart. Look at this breakout here. You had this beautiful parallel channel, and then look at what just happened recently. So that's a dead indicator that you got a bigger breakout likely starting. And then, in fact, if you look at this move up, this is a bullish channel here, and it finally is starting to play out. So it looks good. I mean, it's not back to the highs that we saw in December, January, but it looks like it's going to go, and the next leg should even be higher than that per technical analysis.
I'll show you a good reason why. On this chart I'm showing right now, is you look at Chinese government bond yields, 2.3%. That's a 10-year note yield. We don't go back to 2007. That's 200 basis points below TLT. So is that a safe asset? Probably not. Can anybody buy it? Probably not. But here's the key fact about it. This is the Bloomberg Commodity Index. I fully expect a normal correction of a bull market. It looks like it's just starting to roll over. There's so much room. It's nothing new. It's simple revision, which means the key thing that happens here is the U.S. long bond catches up. It's not a day trade, but at some point, all it needs is a spark. Maybe that's going to be a weak payroll number, and so who knows?
Yeah, I was going to say the payroll numbers tomorrow. I think expectations are for 185,000 jobs added. Right. Unemployment report is supposed to stay at 3.9%. So we'll see what those numbers are. But we did see the ADP come in lighter this week. We saw JOLTS, the job openings, drop pretty dramatically. I was actually a little surprised at that, almost back down to 8 million. Now, it's still not at the pre-COVID levels yet. which is around 7.5 million, if I remember correctly. But it does show a weakening labor market, even if it is taking a little bit of time. And I think it's important to remember that Canada will cut rates this week. The ECB cut rates. So everyone around the U.S. is starting to cut rates. And I think ultimately that opens the door for the Fed to cut rates.
And what are they doing? They're all just catching up to China, the world's second largest economy that's in a severe deflationary, normal reversion of rapidly advancing emerging market growth. We saw it in Japan. We saw the collapse of the Soviet Union is just getting started in China. I like to use the example of what is BYD is doing to Tesla, like Huawei is doing to Apple, and you look at all the G7 countries, they're trying to restrict exports from China for a reason, not because of inflation, and because of severe deflationary forces coming out of that country.
So what do you guys think about this, right? So one of the things that I heard that kind of piqued my interest in the last few days is that Japan, the Japanese central bank, is talking about cutting back on their bond buying. And I don't know if this is something that Scott or you can answer or Mike can answer, but I guess the question is, could you explain to people what that means, why they need to do that, or why they're thinking about doing that?
That guy.
All right.
Yeah. So I'm up here. I haven't pulled up the chart yet, but that's one thing I love. I started trading JGBs in 1995, and everybody said we're short, we're happy, yields are going up. It's the thing I've heard it for 30 years. So yes, they're starting to speak. They want to normalize, and I think it's a wonderful thing. But that's as long as the rest of the world's doing fine. The U.S. economy is doing great. The U.S. stock market's on a tear, and China's not imploding. Yet all those things are probably tilting the other way. Is what I showed you with look what's happening to their neighbor China. Bond yields are declining. So to me, that's a dream. And I think the bigger picture thing is we're going to look back a year from now and say, yes, we are turning Japanese. China right now is turning Japanese. This yield spread was as much, they're just going toward JGBs are about 1%. These are 2.3. A year ago, they were almost 4% in China. China's going that way. What stops that? Well, key thing is you need demand pull from U.S. Not Europe's not happening, and the U.S. is ready for that recession. We all know it. And the Fed can't really ease because inflation's high until the stock market goes down. You see the tilt there? It's just getting started. And I'll use one example: 2011. Remember when the ECB tried to hike rates? That didn't work out very well.
Mm-hmm. So what you're saying is basically them cutting back on bond buying. Is that an effort to normalize and then maybe stabilize their currency too? Does that have an impact on their currency?
Sure. Well, so right now we have the yen at 155. That's one example. Is the main thing we're seeing in a global basis is virtually every country in the world is having to support their currency versus the dollar. Why? Because rates are really high in the world, in the U.S., and low in their countries. And why are rates so low in their countries? Partly you're seeing what's happening in the ECB in Canada because their economies are going down. I mean, it's just, it's sad, but it's silly. So yes, they're trying to normalize. They've been trying to normalize forever. They're trying to now. I think it's going to be a failed attempt.
All right, gotcha. We lost you there, Scott.
I know. I've been having a problem with my camera all day.
No worries. I actually wanted to ask you something. So we've seen the politicians, Donald Trump in particular, starting to warm up to crypto. Obviously, he's doing it for votes, right? Which they all are. But
he's not genuine in his interest.
I'm not sure. We'll just leave it at that. But
well, that's one thing I want to ask both of you. I'm very impressed with. There's one thing you can see that's really happening in this election, and that's China bashing on both sides. But now both sides have turned into really towards pro crypto, and I think that's all. It's quite impressive to see.
Has Biden really turned pro crypto?
He's tilted significantly.
Yeah, I wouldn't call him pro crypto, but I would say that they've taken their foot off the gas a bit in the anti-crypto rhetoric. I mean, he's still vetoed SAB 121, which was a bipartisan bill that passed both the Senate and Congress that was for sensible, very simple rule changing about crypto custody. So I think it's mostly rhetoric from both sides. We'll see how that ticks up in advance of the election based on, I guess, how loud the crypto, sort of constituency is.
And I guess ultimately we know what this is. It's both sides trying to court the younger generations that are more into crypto at this point, right? I mean, I think the older generations have made up their mind one way or the other, but it's probably those younger votes they're angling for.
It's all about what you said, votes. And the thing I always like to point out is crypto's got everything for votes. And the number one thing is I just do the coin market cap. I sort on volume. Tether's number one. The volume is double that of US dollar. They're one of, I think, 15 largest whole treasuries. There's money, there's votes. They track the dollar. It's adopted the dollar as a base layer. They track a lot of treasuries. Any politician who pushes back on that is an idiot. And I think they're starting to figure it out.
So is a CBDC totally dead at this point, Scott? Like, or could it be something that's revived later on after the elections? And
well, Powell said he had no intention of a CBDC, but I don't believe Powell. I don't think that the majority of the government necessarily wants one, but I think that there is a very aggressive push from the Elizabeth Warren side of the left for a central bank digital currency. Listen, I mean, there are over 130 countries experimenting at some level with a central bank digital currency. Digital money of some sort is inevitable. I would argue that we have it to some degree, right? The phasing out of cash is coming. I think we just have to hope that it's not the most nefarious version of that completely eliminates privacy, social credit scoring, money comes out of your wallet if you jaywalk China version that we get. There are very smart people like Chris Giancarlo, who used to be the head of the CFTC. He has a digital dollar project, understanding the inevitable of CBDCs. He has a not-for-profit. He goes around the world talking to central banks and governments about how to do CBDCs in the same way that preserves privacy like cash does. I'm not saying that will happen, but it can technologically be done without it being the worst version possible, which is what we're seeing obviously in China.
Yeah, I was just thinking over here, and I'm thinking to myself, Gareth Soloway at the strip club. How do I make it rain with the digital currency? I'm not really sure.
Yeah, you just you do the thing with your phones. You do this thing that you now do for like airdrops.
Well, the key thing I think there's also indicators here that you just look at the ETH discount before. And now it's almost at parity. It's just what's happened is this the latest approval of ETFs is the trend is your friend, and they're all just figuring out the things we wrote about and talked about years ago, and that is this space will go. They have to have the normal banter and pushback, but now we're at an election. Everybody wants to get elected. It's got money, it's got votes, and the whole space has gone to the dollar as the base layer. Okay, good old American holding your flag. Why push back on that? They're getting it.
That's absolutely right. And now I don't know if you guys saw, but people may not have realized that the dollar was not the dominant currency for crypto trading since last year when the United States government came after crypto. It was the South Korean won. And the dollar now has surpassed 50% again of volume in crypto, largely because of the ETF. So it's fair to say that even the metrics show that it's coming back to the United States to some degree, and the dollar is becoming dominant. And when you throw Tether into that, to Mike's point, it's not even close.
Yeah, just I love pointing that everywhere. I say it as much as I can. Bitcoin is meh compared to trading volume Tether. So number one traded crypto on the planet is the US dollar. It's a token. And what's going to happen is a tokenization of all assets. It's just unstoppable. Yeah, there'll be pushback. There'll be bumps in the road. It's just a better way to transact. And the reason I say it is I came from futures. I saw what futures did to all our assets, most notably US treasuries. I remember being like I am now on the phones in the trading pits, and the guys in New York would get so pissed when the futures were moving the market. I'm like, okay, it's 20 times leverage, and there's these massive guys trading in and out. It'll move the whole market in the world. And that's what tokenization of cryptos is doing. It's just a better way to transact.
So next week we have the big Fed decision, and I assume you both agree no rate cut on the table for this coming one. Fed Watch Tool is at least telling us that. I think September is the first expected cut. But are we going to hear a hawkish or dovish Powell based on what's going on?
So I like Scott's got a new look. It's like the colors of the rainbow. It's coming back. But so you nail it. I just pulled up my WIRP function in terminal. Yes, we don't still full chance of a cut until November, and we love this one. Scott loves it. It's because it's the dangling carrot that never happens, and I'm afraid of what it's going to take for it to happen. Now, obviously, there's getting internal pressure, but when you're the Fed, you have inflation above your targets. I said 3.5% or 4% CPI. It's not really the one they watch, but it's above targets. And massive speculative frenzies in most risk assets. That is the environment that you tighten. Now, they're not going to tighten, but you never ease in that environment. It'd be silly. With the main purpose of the Fed is to pressure that inflation that squashed everybody. History is going to judge this. And this is one of the lessons that Jeff Booth taught us, who's a major Bitcoiner, is where humans are all about error correction. So I think it's silly for him to be dovish. He might make that mistake again. But I think he's realizing by being dovish, he's driving this speculative frenzy and creating inflation. And soon he figures that out, the better.
So when, one of the things we talked about is how the Fed needs to make the stock market come down. So, I mean, does that mean that we could hear a more hawkish Powell than expected? Because really, if you look at the economic data, he might come out a little bit more dovish. Or do you think, like, for my big concern with Powell is that he never seems to really deliver the 1-2 punch to the markets. He's always like, well, yeah, we have to be firm, but we'll watch out. And just in case, we're here with the kid gloves to kind of protect you.
I remember I think he keeps the same sort of tone that he's had previously. Right. Yeah. But that said, I mean, he's going to get questions about about the ECB cutting and Canada cutting. And we also in the past have already talked about South American nations cutting. I mean, there will be more external pressure, not that he cares because he doesn't, being the reserve currency, but it's happening elsewhere now.
So based on their mandate, the Solemn rules kicking in, U.S. employment is picking up. Our estimate is going to be 4%. I think the low is 3.4, 3.6 or so. It's just a matter of time. It goes to 5 or 6. That's what it always done historically. Unless it's different this time, maybe we'll get lucky. But it's just always the way it's worked. So that's the key thing they're watching. Employment's picking up. They have to watch that, and that's their mandate. Maximum employment, low inflation, but we still have high inflation. So, yeah, like Scott said, still the same. But that's the key thing I like to point out is I don't think this thing really kicks in until my prediction based on everything that's happened is rates went up on the elevator. They're going to go down in an escalator very begrudgingly, and that's going to be an elongated, long-term underperformance period for the equity market, which is not profound to say after a period of zero interest rates to give us a very expensive stock market.
All right, so final question before we wrap this Market Mavericks up. In the next month, does gold outperform Bitcoin or does Bitcoin outperform gold?
On a month basis, I can't call it. I wouldn't be surprised if it was gold because I do think the likely scenario based on the past, and listen, anything can happen. This is just, the best guess based on the cycles that Bitcoin kind of ranges up here, maybe touches that 73, 74, gets rejected and, trades in the high 60s, low 70s, unless there's a catalyst. I think gold has more of a convincing catalyst to be up slightly instead of just kind of sideways. But it'll be an arbitrary date in a month when we see which of those things is happening. So
the month is difficult, but that's why I have to show that chart. It's as simple as it comes. Is you do not want to be long Bitcoin, short gold when the S&P 500 is more than 20% above its 100-week moving average. That's in the lifetime of Bitcoin versus gold. Every single time. It's just that's what level. I just look at the way the value at risk hedge funds are looking at this. It's like, oh, here's a trade. Let's put on some leverage. If everybody disagrees it, we'll do more. And I just look at some point that's going to kick in. It's nice we bounced lately, but maybe it's different. And with volatility so extremely low in the stock market, that's what I show on this chart I showed you earlier. It's just that's a trade that at some point it's going to revert. I know people have accused me of picking over time. I just point out the overall trend. I go back to 2017 here. Stock market is expensive. The tilt is towards gold outperforming Bitcoin when you get a normalization, just a little bit of normalization. Oh, by the way, markets do correct in bull markets, except this stock market since 2000, the bottom, October has not, and only been 5%.
Interesting. All right. On that note, guys, thank you so much for participating. It's always a pleasure. Thank you guys for tuning in, everyone watching. Socials are at the bottom. Take a follow there. And we will be back hopefully next Thursday at 3 p.m. sharp with another Market Mavericks. Have a good one, and thank you, guys.
Thanks, guys.